Hello again, everyone. I'm Jim Jeffries, and I want to welcome you to today's presentation, which is co-hosted by the M&A Leadership Council and our partner, BDO. As you may know, the Leadership Council has trained more corporate executives and consultants than any other company in the world today. And today we're sharing insights around valuation, along with an impact that the new tax reform bill is making. Our guest presenter today is my friend Greg Stowe. Greg is a director for the business and analytics practice at BDO and has more than 15 years experience valuing businesses across many industry verticals. Additionally, Greg is the primary presenter on valuations in our Art of M&A due diligence programs, which are held several times per year around the country. Welcome, Greg. Why don't you go ahead and start us off with some grounding on how the tax changes may impact M&A valuations.
Thanks, Jim. Today we're going to look at the changes to the federal tax laws and explore how these changes have impacted the valuation of companies in an M&A setting. The tax law enacted last year has already had an impact on the valuation of companies. There are a number of changes that impact the values of corporations and pass-through entities. We'll focus on the impact on corporations today. So the following tax law changes will have the greatest impact on the valuation of companies in an acquisition setting. First and foremost, the reduction of the corporate tax rate from 35% to 21%. The immediate expensing of qualified capital purchases through 2022 and a phase out through 2027. The limitations on the 15-year term for NOL usage are eliminated for pre-existing NOLs, but new NOLs are limited to 80% of taxable income. And finally, limitations on the deductibility of net interest expense are subject to a 30% cap of taxable income. Now, we'll explore each of these changes in greater detail in the subsequent slides. So while there are several different valuation methodologies that appraisers use, the three most common methods used in a transaction setting are the following: the guideline public company method, the guideline transaction method, and the discounted cash flow method. Now, the GPC method looks at current multiples for publicly traded companies. The guideline transaction method looks at historical transactions and their implied pricing multiples. And finally, the DCF method looks to company-specific cash flows that are discounted at an appropriate risk rate to estimate value. The investment teams that are determining the value of a company will typically use at least one of these methods in some cases, but sometimes all three. Now, let's explore how the tax law changes impact each of these valuation methods. So throughout 2017, as reports came out about the tax changes being considered, the stock markets would fluctuate up and down depending upon who they believed were the perceived winners and losers. In total, though, the markets went up significantly, as it was determined that the overall corporate rate would decline to 21%. Now, until the actual law was passed, transactions that occurred in the second half of the year were still using the old tax rate when determining the expected value under a discounted cash flow analysis. With the rise in the market multiples increased, but the earning measures stayed the same. This led to inflated multiples and a perceived disconnect between the GPC method and the DCF method. Now, once the law was passed, companies and analysts scrambled to adjust earnings estimates that accounted for the actual changes in cash flow and earnings. This allowed the multiples to come back down to more reasonable levels, and the values indicated by the DCF and market approaches fell in line with each other. Now, the guideline transaction method looks at the price paid for a company and divides it by the trailing 12-month measures for revenue, EBITDA, or earnings to calculate the approximate multiple paid per measure of revenue or earnings. Now, since the multiples don't change as the stock market goes up or down, it's hard to apply this methodology to current transactions. So once transactions have occurred that include actual results with the tax changes, then the implied multiples will reset to market levels. Now, the DCF method allows us to model all these tax law changes and provides a better estimate of value. So let's take a look at the changes that will typically be modeled into a DCF analysis. There are several changes that will need to be made to the inputs of the WACC, or the weighted average cost of capital. Now, the WACC includes the cost of equity, the cost of debt, and the capital structure. The key change in the cost of equity calculation will be to the beta. Now, the beta of the guideline companies is typically unlevered and relevered for an appropriate capital structure, and the tax rate impacts this calculation. With the change in the tax rate, there is a small change to the beta as we use the old tax rate to unlever and a new tax rate to relever. Now, these adjustments will tend to increase the cost of equity, though very slightly. Now, the after-tax cost of debt will increase, the after-tax cost of debt will increase since the lower tax rate reduces the value of being able to deduct interest expense. Since we use an after-tax cost of debt, this part of the WACC will increase also. Now, the capital structure will typically change as companies change the way they finance transactions. If interest payments do not have the same tax benefit, companies will tend to use less debt and more equity to pay for acquisitions, which will increase in discount rates and result in lower values. Now let's discuss the cash flow modeling changes. Now companies are allowed to immediately expense 100% of their qualified capital expenditures. This is allowed for each year through 2022, but for years 2023 through 2027, the deduction is going to be limited. In 2023, the deduction is limited to 80% and declines to 20% each year until it is eliminated. For capital expenditures that are not immediately expensable, the balance will be depreciated in normal fashion. Now, a unique feature of this change is that if a company completes a transaction and it's structured as an asset purchase, the acquired tangible assets may qualify for immediate expensing. Now, we expect more companies to take this deduction when the buyer has significant income and can use the deduction to offset their tax liability. This could impact the value that companies are willing to pay in certain situations. Now, net interest expense deductions will be limited to 30% of taxable income. Taxable income is essentially EBITDA through the year 2021 and EBIT thereafter. The net interest expense that is not deductible in any year may be carried forward to use in subsequent years. The interest limitations may have an impact on the pricing of acquired companies. If less interest expense is deductible, buyers may want to reduce the debt portion of their funding, and this will tend to lower purchase prices. Now, one caveat, the interest limitations do not apply to companies with gross receipts of $25 million or less, certain regulated public utilities, and real property businesses. Net operating losses are treated in two ways as a result of the Act. NOLs generated after 2017 are limited to 80% of taxable income and do not allow for carrybacks. NOLs generated prior to 2018 retain their 20-year life and are available to offset 100% of taxable income. As a result, companies will have to track both sets of NOLs. Finally, the corporate tax rate changed to 21%. This is probably the biggest change and will result in more earnings and thus higher values. Now, in addition to the previous changes that we discussed, there are some additional items that, while not typically accounted for in valuations, still may have an impact on the value of certain types of transactions. The repeal of the corporate AMT, or alternative minimum tax, eliminates this tax going forward. For companies that have existing AMT credits, these can still be applied to taxable income in future years. Now, historically, corporations used to be able to deduct from income either 70 or 80% of corporate dividends received. The new tax law lowers this deduction to 50 and 65% respectively. Finally, individuals are allowed to deduct up to 20% of their domestic qualified business income from pass-through entities, such as S-corps, partnerships, etc., with certain income limits lowering this deduction. Now, certain specified service businesses, such as law firms, accounting firms, physician practices, financial services, etc., do not get to take this deduction. Now, finally, what are the best practices in light of these changes? So keep in mind that transaction multiples are based on historical results and will not account for tax law changes appropriately. Until there are more transactions recorded that incorporate these changes, it is best practice to place little reliance on the older multiples. Next, guideline public company multiples should be based on revised earnings measures. If not, then the results will not be accurate. And finally, when preparing a discounted cash flow analysis, the person or persons preparing the analysis must account for all the different changes to give an accurate cash flow estimate, an accurate discount rate, and a better valuation estimate.
Hey, Greg, listen, thanks a lot for this information today. This was insightful. It was quick, but highly relevant, and I think that the audience can appreciate this as a great snapshot of what's to come in the Art of M&A Due Diligence that we'll be offering in San Diego next month. I'd also like to invite anyone in our audience to go to our website, learn more about the Art of M&A Due Diligence, and consider attending any of our upcoming training programs. We look forward to seeing you out in beautiful San Diego in July next month, or in Scottsdale, Arizona in November. Greg, that was nice. I very much appreciate it, and look forward to seeing you out in San Diego. Thanks, everyone. Good day.